Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How you doing today? Hope you're having a good day, and I hope you'll keep us in mind at Jazz Wealth. We're financial advisors that teach and go through every little bit of your personal finances, your investments, anything that you want help with. We're happy to help you here, regardless of your account size, whether you're just beginning or you're just about to retire or in retirement. Happy to help you there. So today we're going to kind of follow up with what we talked about yesterday, which was what's the best index. Now I'll let you go back and watch that video, but we talked about there being a way to maybe speed up or slow down by building a portfolio. Meaning we saw the net. Let's just show it. Come on, let's go to the charts here. So we went to the charts and we posted the performance here. I'm going to use the last 10 years of the NASDAQ. That's the purple line that you see there. S&P, Dow, and Russell were down here at the bottom. So there was a clear outperformance, and we said, well, maybe this is what you want to shoot for over a 10-year period, but you should probably look back a little bit further. So we went back a little bit further, and we found that, okay, over the long term, right, last 20 years, the Russell was actually the better performer. But what if you were someone that said, I need something in between, right? We find that between the dollars you're saving and the risk you're taking, you're not quite going to get to your goal if you invest down here in one of these. You got to be somewhere up here. So you have to accept that extra risk. You got to kind of do that. Now, we do this with all of our portfolios here at Jazz. In fact, I just shared in our last portfolio update how that happens, right? Actually show people how we speed up and slow down and everything so they know why we're doing what we're doing to make sure, you're investing for your goals. Now, what I'm going to do is go back to the 10-year here because this gave us a bigger white space to work with, and it helps me illustrate my point. Of course, you would want to do this over a long term. In my opinion, I think you would want to do it over a long term. This today is just simply for convenience for me to show the difference, and you'll see in a second. The first thing I'm going to do is I'm going to present the scenario where somebody says, I like this return here, right? I like how good things look, but I'm not willing to accept such severe pullbacks. That's a lot of volatility. Look how hard this thing falls when the rest of everything else just falls a little bit less. I don't know if I like that. However, I don't think that I like down here either. Dustin, do some work and get me somewhere in between. Help me work something out here. So I'm going to say that you're trying to decide of some mix between the S&P and the NASDAQ. So I'm going to get rid of the Russell, and I'm going to get rid of the Dow. There we go. So now we just have a cleaner chart. You could do this in any way you like, but I want a cleaner chart here. So we've got the S&P down here, the NASDAQ up here, and you go, well, I don't like that, and I don't like this. Put me in the middle somewhere. So what we did, super simple. This is in no way me trying to show off or do anything. I'm just trying to go with a real simple example so you have a starting point here. Let's just say we go, what about a 60-40 split? What if we go 60% in the NASDAQ, the Qs, and we go 40% in the S&P? By the way, this is absolutely not a suggestion. Please do not go do this. I am not recommending that you do this. I'm trying to show you how you can invest for your goals and quit worrying about everybody else. All right, so what we did is we built a portfolio. We said, all right, let's go back and let's do a 60-40 split of each of them and see the performance. And here you have it on the chart. That's your light blue line. So by going 60% in the NASDAQ, 40% in the S&P, you'd actually think it'd be a little bit lower, but the overall results turn out to be just a little bit less than the NASDAQ, just by simply going 60% here and 40% there. But what if that wasn't good enough? Well, first of all, we took a random shot in the dark. I had no idea how this would turn out. I just simply said 60-40, model it, let's see what happens. Very similar to going like in a room. Someone blindfolds you and they say, go in there, and you can't come out until you find the other wall, right? And you use a gun. You can shoot something, and here, if you see it hits anything, I don't know why why am I even giving this as an example? It's just a shot in the dark, right? So I guess that's why I thought about it. So you pull the trigger, and you don't hear anything. The gun goes off. You listen. There's nothing there. It didn't hit anything. Well, you're not going to walk that way, right? You don't know if you're on a 100-story building and you walk over the edge of something. You don't know, right? The guy's like, just go try to find the wall. So you turn a little bit, and you shoot that way, and a couple seconds later, you hear ping. You know the wall's over there. Got to go that direction, right? So the 60-40 split, simply just a shot in the dark, despite my poor attempt at an analogy there. All right, well, what if we did 40-60? Let's just flip it on its head. Let's go 40% in the NASDAQ and 60% in the S&P. That surely has to slow it down a little bit, and that's going to be your light green line that you see on the charts. Now we might have something that somebody can work with, right? And I do this with all my customers here. I do it with their 401ks as well. I go, show me what you have. Tell me what you want, right? I already know what goals you're shooting for, but tell me what scares you at night. Tell me if it worries you when the markets go up and down or not. And we try to find that mix where they're being as efficient as possible with their money while still going for their overall goal. If I take the 60-40 out for a second and just plot the NASDAQ, the S&P, and a 40-60 split. Now we've slowed down to a point where maybe it's acceptable for someone. We could keep playing that game, right? We could keep scaling back and keep showing the data. I'm not showing it here, but we can actually show you max drawdown. We can show you the volatility you're expecting, the standard deviation of your returns. So you know that, all right, if I lose 8% in a year, that's expected. It's totally normal within expectations. This data really helps you sort of visualize where you need to be relative to your goal. And even better, it helps you understand that we can now model a projection going forward. We're going to use a lot more data than this. We certainly want to go back further and make sure we're adjusting along the way. But we can actually go, okay, if you are punching in a calculator somewhere going, I expect to make 7% a year. Okay, well, how do you know you're going to make that? How do you know it's not going to be 6 as an average? How do you know it's not going to be 8.5 and you're actually saving too much money? You don't have to bother saving as much money. That's what I want to get at. That's the point of kind of what we've been talking about over the last 2 days, and I hope you enjoyed it. If you have a IRA, a Roth IRA, whatever, and you've been thinking about working with us here, I hope you'll give us a shot at Jazz Wealth. Remember, I will do this for your 401ks. I'll do it for any investments that you want because I want you to know that every last dollar you have is moving towards the goal. I don't care if we only manage your Roth IRA and other advisors are like, well, you're not paying me for those, so I'm not going to help you there. No. Whatever we're doing for you, we will dial it in. Whatever we're going to try to help you with, everything else, that's just purely so that your nest egg grows. Simply. That's it. I mean, it's the right thing to do. And so that's what we do here at Jazz. I hope you'll keep us in mind. I also hope you'll check us out at 5 o'clock today, every day at 5 o'clock Eastern Time on YouTube, Jazz Wealth Managers, as well as on Roku, the Investors Business Network. We are live at 5, and we do a closing beat show. That's what we call it. It is a stock market update, just to let you know how things have gone. Good, the bad, and the ugly. But if you can't make it, I understand. Maybe you'll hit the thumbs up button or subscribe button and all that good stuff. Have a great rest of your day, and we'll talk to you soon.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.